Hi, everybody, and welcome back to video number 2 in Chapter 7. When we left off, we were looking at the Gap, which uses a perpetual inventory system. And so they have 50 t-shirts that cost $34 each here. During June, the Gap purchased another 150 units at $34 each on account and returned 6 t-shirts for credit and sold 125 t-shirts at $45 each on account. So they want to see the journals for the June inventory transactions and how that looks in T account format when we post those transactions to the inventory account and eventually calculate our ending inventory balance. So beginning is 50, we added 150, we sold 125. So here it is. Here is our inventory that we purchased. We purchased inventory here for 150 of them at $34, $5,100, and we sold it on account. And then when we sold, though, let's go back, these 6 units were returned. So when we returned that, we're pretty much going to reverse this entry that we did here. So that was worth $204, 6 times $34. And then we have our accounts receivable for the units we sold. We sold 125 at $45 for a total of $5,625. And the cost of goods sold that goes with that would be 125 units times $34, which was our cost. So if I put that all these inventory transactions into T account format, our beginning inventory, we had 50 of them at 34. We purchased another 5,100. That gives us our available inventory. There were returns of 6 units and sales of 125 units. So our ending inventory then would be $2,346. Okay, let's determine the goods and costs included in inventory. What do we include in inventory? Of course, we're going to recognize inventory and accounts payable at the time it controls the assets. So passage of title is important in determining when you have control of that inventory because your rights and obligations are established legally. So if it's FOB destination, that's the shipper's inventory in transit. However, if it's FOB site of manufacturer, then from their plant to our plant, we are responsible for that in transit shipping. And here is that example, terms of sale. FOB shipping point. Here's the shipping point. When it's FOB shipping point, we, the buyer, are responsible for that inventory. The minute the buyer puts it on the back of the truck and shuts those doors, that's our inventory. And if something happens to it in transit, we're responsible. On the other hand, if it's FOB destination, the seller's paying for freight costs. Okay. Freight costs are included in inventory if it's FOB shipping point. Okay, consigned goods. Goods on consignment remain the property of the consignor. They may be on in our premises, but they're not our inventory. I'm reminded of when I lived in Michigan. There was a little boutique store in downtown Birmingham that sold these beautiful wood-carved ducks. They were very expensive. They were decoys, theoretically. I don't think anyone would use them for that, but beautifully done. And I asked the owner of the shop, are those, how do you get those? She said, well, they're on consignment. They're not our property. We just get a commission when we sell them. So that's exactly what the consignee, this would be the owner of the shop in Birmingham, they make no entry for the inventory accounts for the goods they receive because they're not their inventory. Okay, sales with returns. The transfer of legal title is used to determine whether a company should include an item in inventory. So if you have sales with high rates of return, that's going to illustrate problems that companies may encounter. So here is an example. Quality publishing companies selling textbooks to campus bookstores with an agreement that the campus may return for full credit any books not sold. Historically, the campus bookstores return approximately 25% of the textbooks from quality publishing. So, how should quality publishing report its sales transactions with the campus bookstores? This is a little tricky. The key question to determine is whether a sale occurs. Has quality publishing transfer control of these goods to the campus bookstore? Because the campus bookstore now has the ability to direct the use and obtain substantially all the benefits from these textbooks, they normally would record these as a sale from quality publishing. In addition, the normal indicators for transfer of control, such as passage of legal title, loss of physical control, etc., have occurred. However, quality publishing must also recognize that only partial control has been transferred to the campus bookstore. So, quality publishing is going to do the following. They'll record the sales revenue at the amount it expects to receive from the transaction. And you'll remember from chapter 6 that involves variable consideration. So the transaction price then is adjusted to recognize that a portion of these textbooks are going to be returned. Next, we're going to take a look at establishing an estimated inventory return account to recognize that some of its textbooks will be returned. The reason for recording estimated inventory return is that control over a significant number of textbooks has not passed to the campus bookstore. Okay, special agreements. And here we have sales with a repurchase agreement, often referred to as a repurchase or product financing agreement, which is usually going to involve a transfer, a sale, with either an implicit or explicit repurchase agreement. These arrangements are often described in practice as parking transactions. Okay. Now, product costs versus period costs. Here are product costs pretty easy conceptually to understand. Those are the costs directly connected with bringing the goods to the buyer's place of business and converting such goods to a saleable condition. All right. Period costs are indirectly related to the acquisition of goods and are generally more difficult to assign to specific inventory items. All right, so let's look at that in a little more depth here. Here's our product costs. Freight charges on the goods that we purchased when we're responsible for inbound transportation. We're going to include that in inventory. Include that in inventory. Any insurance costs incurred by the buyer while the goods are in transit are part of inventory. Unpacking and unloading costs, if significant, are part of inventory. Preparing the goods for sale. Sometimes we need to spruce them up a little bit. And those are part of inventory's product costs. But the period costs are different. Selling expenses. Our salespeople may get a commission on selling that. And interest costs related to financing the inventory purchases. We're going to charge that to interest, not to inventory. And G&A, our lovely accounting staff, is included in that. And we're going to charge that as a period cost. We expense all of these as incurred on the income statement. Okay, purchase discounts can be accounted for either the gross method or the net method. Under the gross method, a company records its purchases and accounts payable at the invoice price. Under the net method, a company recognizes the purchase and related accounts payable at the invoice price less the cash discount. All right, let's look at this. The facts. We assume B Cycle has the following transactions. They purchased bicycle inventory with a cost of $10,000, terms 210 net 30. Invoices of $4,000 are paid within the discount period, but invoices of $6,000 are paid after the discount period. How should B Cycle record that? Well, under the gross method, we're going to record the full $10,000. This is the normal method. It's the one that I use, to be honest about it. And then as we find out exactly if they took the discount or not, our accounts payable will be reduced by the $4,000 before the discount. We'll credit a purchase discount for $80 and credit cash for $39.20. Okay, but because the $6,000 was outside the discount period, we're just going to debit accounts payable for the entire amount and credit cash to pay for it because we did not take the discount. But under the net method, we pretend that everything is going to be that discounts are going to be taken. So we assume that $200 immediately in our purchases here at $9,800. And that's okay when you have the $4,000 here, because now I can just debit accounts payable for $39.20 and credit cash for $39.20. However, when we don't take the discount, we need to make a little adjustment here, and that's to the purchase discounts lost. So again, we'll reduce accounts payable, but we're going to have purchase discounts lost, and our cash will go down by $6,000. And using perpetual inventory system, entries to purchase and purchase discounts are reported in the inventory account. Okay, so here's the Guard company. It sells basketball and basketball hoops and is analyzing the following information. Guard took physical inventory of the basketballs on December 31st, determined there were 200,000 worth of basketballs on hand. Not included in the physical count were 25,000 of basketballs purchased from Ryan Company. FOB shipping point, so we're responsible for the inbound transportation, and 22,000 of basketballs sold to Moore for 30,000. So here's the information related to that. What amount should Guard report on its inventory, and what is Guard's inventoriable cost related to those basketball hoops? We will have to wait till video number 3 to find out those answers. So that will end video number 2, and when we come back, we'll look at this one in a little more depth. Until that time, bye for now.